The program introduces multi-factor models as advanced approaches for explaining asset returns and measuring portfolio risk. Unlike the capital asset pricing model, which assumes that market risk alone determines expected returns, multi-factor models recognize that multiple economic and financial variables influence security performance. These variables, or factors, may include interest rates, inflation, economic growth, exchange rates, credit spreads, industry characteristics, and company-specific attributes such as size or value orientation. Multi-factor models provide a more flexible and realistic framework for analyzing investment behavior because they capture broader sources of systematic risk. The program emphasizes that these models improve portfolio construction, performance attribution, and risk management in increasingly complex financial markets. The program explains that multi-factor models rely on several important assumptions regarding market behavior and investor decision-making. First, asset returns are assumed to be influenced by a combination of identifiable systematic factors and random firm-specific effects. Second, factor sensitivities remain relatively stable over the evaluation period, allowing analysts to estimate relationships statistically. Third, unsystematic risk can be diversified away in large portfolios, leaving factor exposures as the primary drivers of return variation. Multi-factor models also assume that historical data can provide meaningful insights into future relationships between factors and asset performance. Although these assumptions simplify real-world conditions, the models remain valuable tools for identifying common sources of risk and understanding portfolio return dynamics. A key concept within multi-factor modeling is factor sensitivity, often measured through factor loadings or betas. Factor loadings estimate how strongly an individual security or portfolio responds to changes in a specific risk factor. For example, a portfolio with high sensitivity to interest rates may experience significant value changes when central bank policies shift. Multi-factor models may include macroeconomic factors, statistical factors derived from historical correlations, or fundamental factors linked to company characteristics. The program highlights that selecting appropriate factors is essential because poor factor specification can reduce explanatory power and produce misleading results. Analysts therefore use economic reasoning, statistical testing, and historical analysis to determine which factors meaningfully influence asset returns. Topic focuses on the practical application of multi-factor models in portfolio management and risk analysis. Investment managers use these models to decompose returns into contributions from individual factors and security selection decisions. Multi-factor analysis allows firms to identify unintended risk exposures, evaluate diversification effectiveness, and assess how macroeconomic changes may influence portfolio performance. The program explains that factor models are widely used for stress testing, scenario analysis, and portfolio optimization. By understanding how different assets respond to economic variables, managers can design portfolios that better align with investment objectives and risk tolerance. Multi-factor models also help institutions manage systematic risk exposures more efficiently across large and complex investment portfolios. The program also discusses the use of multi-factor models in active portfolio management and performance evaluation. Managers often seek to generate alpha by intentionally tilting portfolios toward factors expected to outperform over time. Common factor strategies include value investing, momentum investing, quality investing, and low volatility investing. Multi-factor frameworks allow analysts to distinguish returns generated from factor exposures versus genuine manager skill. This distinction is critical because investors need to determine whether excess returns reflect repeatable strategies or simply compensation for taking systematic risk. The program emphasizes that multi-factor models improve transparency and accountability by providing detailed explanations of portfolio behavior under different economic and market conditions. The topics conclude by emphasizing both the strengths and limitations of multi-factor models in financial risk management. These models offer significant advantages by capturing multiple drivers of asset returns, improving diversification analysis, and supporting more sophisticated portfolio construction techniques. However, factor relationships may change over time, especially during periods of financial stress or structural economic shifts. Model risk also arises when assumptions, factor selection, or statistical estimates prove inaccurate. The program therefore stresses the importance of combining quantitative analysis with professional judgment and ongoing monitoring. Successful application of multi-factor models requires careful interpretation, robust data analysis, and awareness of evolving market dynamics within global financial systems.